Once you've done that, everything is automatic, which means that every month, without you having to do anything, the money from your bank is automatically deducted to be invested into the investment product that you have specified right at the start of this process. So this is very important. It's automatic. So that also means that it helps investors to instill financial discipline. And on top of that, RSP, you can subscribe to RSPs for a wide range of investment products. So besides individual stocks, unit trusts, you can also use RSPs for ETFs as well. And actually ETFs is the main focus of my presentation today. Now, the RSPs actually utilizes this concept of dollar cost averaging. How this works is actually the fact that the same amount of money is actually invested at regular intervals, regardless of the unit price, which means that every month, whether the stock market goes up or whether the stock market goes down, that fixed sum of money will be invested into the investment product of your choice. But of course, when the price is low, you'll get to buy more units, and of course, the converse is true as well. When prices go down, you will be able to buy. When prices go up, you buy less units on that particular month. So on this particular slide, I've actually prepared a very simple example to illustrate how this dollar cost averaging concept works. Okay, so this particular investor, he sets aside about $100 every month to invest in this particular investment product. So in the month of Jan, okay, the price of that investment is actually $10. So which also means that with his regular contribution of $100, he is able to get 10 units for that investment product that he is invested in. And in the month of Feb, the price of this investment goes up by 50 cents. But the monthly contribution of this investor, it still remains $100. But it also means that with the higher price, this investor is able to buy less units from the market. And in the month of March, the price goes down to $9.80. And same thing, contribution remains at $100. But this time around, the amount of units that this investor is able to invest in, it goes up to 10.2 units. So the same thing applies for April and May. And in the long run, this investor who does an RSP for a long period of time, he gets an average price. And in this particular example, the average price of the investor for this particular investment is actually $9.86. Okay, so this is by and large some of the basics related to regular savings plans and the mechanism of RSPs. Now, I'd like to move on to some of the reasons why investors should consider RSPs for their portfolios. And I just wanted to share over the next few slides what are some of the benefits that are usually associated with regular savings plans. Now, the first benefit is that RSPs, it allows you to get started with investing with very limited capital. Now, this situation is especially true for the younger investors, for those who are still studying, or for young adults who are just getting started on their first job. So these investors, they usually don't have a lot of capital to invest. Maybe on a monthly basis, they can just set aside maybe $50 to $100. And for this kind of investors, with RSPs, they can get started on their investment journey because with as little as $50 a month, RSP actually allow investors to get started on their investment journey. And this is also very helpful, particularly if the investment product that we are looking at, it requires a huge initial lump sum investment. Now, in the Singapore market, if you just want to invest in like let's say a stock, just to get one lot of DBS shares based on its last traded price, you actually need at least about $1,000 plus, close to $2,000 just to invest in one lot of DBS shares. And on top of that, if you want to invest in things like unit trusts, sometimes the lump sum investment for these investment products are about $1,000. So for RSPs, with just $50 a month, you can get started on your investment journey. You don't have to wait to accumulate thousands of dollars before you can start your investment journey. So starting earlier also comes with the benefit of allowing your investments to benefit from compounding returns. So starting early is very important. And on top of that, there is potential cost savings, because if you use an RSP to do your investments, right now, if you go out into the stock market, if you pick up, one lot of shares or one lot of an ETF, your minimum cost that you're likely to incur is at least $10. But if you're going to do your investments, your ETF investments using a regular savings plan, then the transaction cost that you're looking at is just $1. Okay, of course, these charges applies to the clients of FSM1. So how we charge is it's 0.08% for ETF RSPs with a minimum $1. So there are potential cost savings if you decide to do your investments using an RSP. Okay. And on top of that, RSPs can help us to avoid emotional investing. It is actually a very disciplined approach for investors to investing. Now, in the world of investments, every time we say the secret of investment success is actually to buy low and sell high. But buying low and selling high is actually near impossible, especially if investors let their emotions control their investment decisions. Now, I think this year has actually shown us that buying low and selling high is actually very difficult to do, because when prices are actually low, like what we are seeing right now, people are so fearful of the markets. They are afraid because they think the markets, they are going to fall further, or they think they are not at the bottom yet, so they are going to try to catch the bottom of the market. And on top of that, when markets are rising, last year, when markets are just on a very strong run, there are also investors out there who have this fear of missing out on potential gains in the future. So even when markets are going up, they are still willing to put additional capital into the stock markets. So what most investors do, especially if they let emotions control them, is they end up buying high and selling low. So if you have sold this year after the market has crashed and burned, then you are actually investing based on your own emotions. So in this case, RSPs can actually help us, because RSPs is automatic. Whether you like it or not, every month, the same fixed amount of money will be deducted from your bank account. So it is a very disciplined way for us to stay invested, irrespective of market conditions. Okay, so the next benefit of RSPs is that it actually helps us to avoid the pitfalls that are generally associated with market timing. Now, I think I've said this just now, but I think for those investors who are trying to catch the bottom of the market, it is possible for investors to do that, but it is actually near impossible to do this on a consistent basis. Not even Warren Buffett can time the market on a consistent basis. And RSPs can actually help us to avoid market timing at the wrong times. Now, at this stage, I just wanted to go back to the example that I showed everyone in my previous slide just now. So some investors will be looking at this table and asking themselves, okay, so in the long run, I'm getting an average price of about $9.86. So why don't I just get in the month of May when the price is at $9? I just throw in all my $500 in the month of May. I get $9, and I actually stand to get a much potentially higher return compared to my average price of 9.86%. This kind of thinking, it is actually true, okay, but it is only true if you can correctly predict that May is the bottom of the market. If you can correctly predict that at May, you will be able to secure that $9 per share for this particular investment. Chances are, when we are in March or when we are in April, I think in March we'll probably be thinking 980. Okay, seems like a good price. Okay, let me lock in that price now, and I'll get 980. And for investors who want to time the market, you probably need to spend a lot of time doing market research as well. So you need to spend time. Whereas for RSPs, you just need to let the system automatically invest on your behalf. You can sit back and enjoy. And for doing nothing, you get an average price of 9.86%, which is actually not too bad, given that it is actually using a dollar cost averaging concept. Okay, on this particular slide, I just wanted to use SARS the SARS episode as an example of why market timing is actually so difficult for investors. So on this particular slide here, it is actually the performance of a Hang Seng index during SARS back in 2002 and 2003. So now if you look at my chart over here, so now if I look at it, I can know very well that the best time for the investor to get in during the SARS period was actually in April 2003. Okay, so now, right now, I just want everyone to go back in time to April 2003, when markets are falling and when there is so much fear in the market. In April 2003, okay, ask yourself this question. Do you think you are willing to do a large lump sum investment in April 2003, when market conditions are so volatile and there is also the possibility that it could drop further? I think for most of us here, this is probably quite a high risk thing to do, especially if there's so much fear. We don't know how markets are going to react. Everything is so unpredictable. Chances are we probably won't invest. And we probably will wait until, let's say, maybe May or June, when markets start to do a sustained rebound. And then we say, oh, okay, actually, we are at the bottom of the market right now. I look back in April and I conclude that, okay, that is the bottom of the market and it is time for us to start buying right now. So in April, none of us will know that this is the market bottom. And the market bottom will only be known after we have reached the bottom and after a period of time has passed. So there is no way we are able to catch the bottom. Okay, for some of us, maybe you can, but I think for most of us out there, it's near impossible for us to do it and do it on a consistent basis. And also for some people, okay, they might look at, December 2002 when there was a sudden rebound. Okay, some people might conclude that in December 2002, that was the bottom. Okay, but for investors who did that, they will also realize, unfortunately, that wasn't actually the bottom. It was just a brief rebound before the markets actually continued to sell off all the way until April 2003, when it was actually the market bottom. So I just wanted to use this example to illustrate why market timing can sometimes be so difficult for the average investor out there to do, which is why RSP is something valuable, especially in times of market crisis. And I think the power of RSP really shines out whenever there is a market downturn. And I think if there is one particular slide that I want to highlight especially today, I think it is this particular slide. I think the power of RSP really shines out whenever there is a market crisis. And I just want to show you some facts and figures using previous crises as an example. So if you look at this particular table here, so I've actually calculated the amount of losses that a lump sum investor, so I basically made a comparison between an investor who makes a lump sum investment right before the crisis hit versus an investor who did RSP from the start of the crisis all the way to the end of the crisis. So I did the performance comparison between these two investors. So here's actually what I found. So if you compare the performance of the lump sum investor versus the RSP, okay, you can see that in the tech bubble and global financial crisis, as well as the Chinese equity market, the Chinese equity market crashed back in 2015 to 2016. Investors who did the RSP method of investing, their investment performance was better than the investors who did a lump sum investment just before the market crashed. And also, the amount of time it took for both investors to break even, it is also very different as well. So for the lump sum investor, the number of months it took for this investor to break even on his investments is actually 74 months for the tech bubble, if you're talking about S&P 500, 53 months for global financial crisis, and again, referring to the S&P 500. Now, for investors who invested at the peak for the Chinese equity market before it eventually crashed, even after close to 5 years, this group of investors, they haven't actually broken even on their investments. So it is still ongoing. But whereas if you look at the RSP investor, okay, I think if you look all the way down to the CSI 300, which is the benchmark for the Chinese equity market, investors who did an RSP from the start of the market crash all the way to the end, they would have taken just 25 months to break even on their investment. So which means by now, you would have broken even on your investment if you had invested throughout the market crash using an RSP. And all these while doing nothing, because RSPs are automatic. Okay, so at this stage, I hope I have convinced you about some of the merits of using RSP inside your portfolio. So I wanted to also spend some time to help everyone to visualize and also to illustrate what is the kind of money or rather capital that they can accumulate over time using an RSP. So now if you take a look at this particular table over here. So for investors who are doing a monthly RSP of just $100 every month, now assuming a rate of return of 2%, which means that every year you're getting 2% returns, and over a span of 20 years, this particular investor can accumulate $29,500 by the end of the 20 years. Okay, but of course in this case, I'm using quite a low rate of return. And if you're invested in Singapore government bonds, then 2% return is probably something that you can reasonably expect. Okay, but for those people who are invested in the stock markets, if you have a portfolio that is 100% into the stocks, invested into the stock market, then the kind of return that you should be expecting is it should be at least 8%, okay, or maybe even higher at about 10%. Okay. At 8% rate of return after 20 years, okay, this investor can get about $58,900. For investors who are just invested in corporate bonds, for example, then perhaps 4% rate of return is something more realistic. And also for investors who do a combination of both bonds and stocks inside their portfolio, then maybe 6% rate of return is something more realistic for this particular group of investors. Now, under a RSP 500 per month scenario, then of course the amount of money that you can accumulate is of course more. So assuming 10% rate of return, and at the end of 20 years, we can actually get a sum of close to 380K. And if you increase your RSP amount to $1,000 every month, if you're willing to set aside $1,000 every month, at the end of 20 years, assuming again a 10% rate of return, you are able to accumulate quite a big sum of money at about 760K. Okay, so I just wanted to highlight also that there are some factors that will affect how much money that you can accumulate. So obviously one of the factors that affects the amount of money that you can accumulate is the amount of money that you set aside every month. So that's number one. Number two, the rate of return that you can get from your investments, that is also another important thing as well. The higher rate of return that you can achieve, then of course, the more money you can accumulate by the end of your investment horizon. Now, the last thing also is your holding period is also very important. Now, whether you hold your investments, whether you invest for 5 years or 20 years, it makes a huge difference because when it comes to investing, okay, if you are young, okay, the advice that we usually give to investors is that if you have not started on investing, please start as soon as you can, because time in the market is also important. And you can also look at all these examples, and you can conclude that 5 years invested in the market versus 20 years invested in the market, it makes a huge difference. 20 years gives you 760K, but if you're just in the market for 5 or 10 years, you're not getting even half of that amount you're getting in 20 years time. So that's something to take note of. So if not having enough capital is keeping you away from investing, I'd like to encourage you to actually consider RSP as a way to start your investment journey, because you don't need tens of thousands of dollars to get started. All you need to do is set aside at least a small amount of $50 every month, and you can get started. Okay, so over the next few slides, I just wanted to share with everyone also how you can build a portfolio from scratch. Okay, now this is assuming that you do not have any investments at all. So over the next few slides, I just wanted to show everyone a way to build a portfolio using RSPs. Now, this is actually a very simple method. It's a very simple three-step method that begins with asset allocation, product selection, and lastly, a review and rebalancing of the portfolios. Okay, so I will start off with the very first step, which is asset allocation. So I think for those of you who are actually not familiar with what asset allocation means, okay, so basically what asset allocation aims to achieve is or rather at this particular step, what the investor is trying to achieve is the investor has to decide what asset classes he or she wants to be invested in, and also in what proportions does the investor want to invest in all these different asset classes. So in this very simple example here, I have used just two asset classes, two commonly used asset classes, which is stocks and bonds. So for this particular investor, okay, assuming that he is a conservative investor, a conservative investor, they tend to have a short investment horizon. They are probably more suitable for retirees who are nearing, or for adults who are nearing retirement age. So for these group of investors, they can't afford to lose too much of their portfolio value. So capital preservation is a main objective for this group of people. So a conservative portfolio that has about 90% allocation to bonds and 10% to stocks, it could be something that this group of investors might want to consider. And of course, on the other end of the spectrum, you also have the more aggressive investors. So aggressive investors, they generally tend to have a longer investment horizon. So for young adults, for students, or for adults with no immediate financial obligations, they can come under aggressive investors. And the kind of allocation that they want to do for their portfolios is about 90% allocation to stocks and 10% to bonds. And also in the middle, if you're not comfortable with either of the two extremes, then of course there is somewhere in between. If you think you are a balanced investor, you want to participate in the long run upside potential of equity markets, but yet at the same time you want to have a bit of the downside protection, then maybe a balanced portfolio or a moderately aggressive portfolio is something that you can consider. Now, okay, so the question here is, for the average investor, okay, whenever there is a market crash, how do they take advantage of very cheap equity market valuations? Or conversely, if markets are on a very strong bull run and valuations are actually very expensive, how do they actually adjust their portfolios? So you can actually adjust your portfolios accordingly. Okay, so for instance, when stocks are cheap, okay, like this year, for example, after the market crash associated with COVID-19, equity market valuations are actually getting a bit more reasonable. So this is perhaps the time for investors to consider whether they want to change their portfolio allocations. So I'd like to use one portfolio as an example. Okay, so at the start, okay, for the balanced portfolio, my allocation is 50-50. Okay, but in this case, if I think stocks are offering a very good value for investors, if I think, stock markets are cheap and I think now is perhaps the right time for me to have a bit more exposure into the stock markets, I can actually adjust my allocation from 50% to about 60%. Some people want to take a bit more risk, they adjust it to about 70-30. Okay, and of course, the converse is also true. When stocks are expensive, for the balanced portfolio, maybe this investor wants to reduce his exposure to the equity markets. So he decides to reduce his equity allocation from 50% to 40%. Okay. And at this stage, I just want to also highlight that these percentages are not a hard and fast rule. Ultimately, it is down to your own personal preference. So even if you are a young investor, it doesn't necessarily mean that you are an aggressive investor, because some investors, they may not be comfortable with huge losses in their portfolios. And for aggressive portfolios, if you are in a market crash, your losses can be as much as 20. And if it's a crisis like the global financial crisis, the amount of losses that you're looking at, it can go up to 30-40%. So if you are not comfortable with such huge losses inside your portfolio, then perhaps you are not suited to be an aggressive investor. And also, there are also some investors out there who want to invest beyond just stocks and bonds. Some people, they might want to consider having gold inside their portfolio as a form of a hedge against equity market volatility. This is also fine as well. Okay. Ultimately, the most important thing is to firstly, you need to have a plan. Without a plan, you are not able to achieve success in investments. So have a plan and ensure that you stick to that plan that you have come up with from this step number 1. Now, after you have decided what percentages or what asset classes you want to invest in and in what percentages, the next step is, of course, to choose the products, the suitable products for you to get exposure to each of these individual asset classes. Now, there are quite a number of products that you can choose from. So you can choose from unit trusts, ETFs, stocks, bonds as well. Okay, but for today's seminar, I'll just be using ETFs to illustrate this entire process. Okay, so how can you choose the right ETF for a portfolio? Okay, now generally speaking, ETFs, the job of ETFs is really to replicate the underlying index replicate the performance of the underlying index that they are tracking. So I think one quite popular ETF in the Singapore market right now is actually the SPDR, SPDR, Straits Times Index ETF. So what this ETF does is it replicates the performance of the Straits Times Index. If the STI goes up by 5% today, then the ETF is expected to deliver returns of close to 5%. So this is how ETF works. So you can never expect ETF to outperform the market. So when you are choosing the right ETF for your portfolio, ideally, you should be looking at the ETF that gives you the returns that is closest to the index, but at the cheapest cost. Okay, so very broadly speaking, okay, there are 3 categories that you can consider when you are choosing an ETF for your portfolio. So the first one is, of course, expense ratios. So the lower the expense ratio, the better it is for investors. ETFs are very cheap, very low-cost investment vehicle for investors to gain exposure to the markets, but it doesn't mean that it is no cost. There is a cost that you have to pay, even though it's quite low. So you might want to factor that into your consideration whenever you are comparing between 2 ETFs. Okay, tracking difference is actually, it measures the difference in terms of the performance between the ETF as well as the underlying index. So like I said just now, the job of the ETF is to replicate the index, which means that it should deliver a return that is closest to its underlying index, which also means that the tracking difference should be as low as possible. Okay, last but not least, because ETFs are exchange traded, so you might want to consider the liquidity of that ETF as well, especially if you want to get in or out of a position very quickly. You might want to take into consideration the liquidity of the ETF that you are considering for your portfolios. Okay, after selecting the suitable ETFs for your portfolio, the last step in this process is really to just monitor your portfolios and do a rebalancing if there is a need to. Now, when I say monitor and review your portfolio, I don't actually mean you look at the portfolio value every single day. Okay, you don't actually have to do that. I think maybe once a quarter is it's quite an okay time frame. And if you want to be a bit more hands-on with the performance of your portfolios, then perhaps once every month, I think that's fine as well. So how do you review? Your portfolios? I think first and foremost, you need to see whether you want to make any changes to your asset allocation. So like I said just now, if right now you think valuations are cheap and you have allocated quite a sizable amount to equity markets, but maybe half a year, maybe 1 year down the road, conditions may have changed, markets could have recovered, and at the end of the year, this could also be the time to maybe consider reducing your exposure to equities and perhaps take some profits off the table. So this is what I mean by reviewing and monitoring your portfolios. And also for the products that you have selected for your portfolios, some of them might turn out to be not so suitable after all. So for instance, if the ETF that you have chosen for your portfolio, it's not delivering returns that it's expected, you can actually replace that ETF with another suitable product out in the market. Okay. Last but not least, you can also consider doing a rebalancing, especially when your portfolio allocation has deviated substantially from the initial target. So initially, if you're a balanced investor and you have a 50-50 allocation to bonds and stocks, maybe at the end of the year, you find that because markets have moved by so much, it is no longer 50-50. In fact, it could be about 40% to stocks and 60% to bonds. So rebalancing means you sell your bonds and bring it back to the original 50%, and you buy stocks and bring it back to the original 50%. So instead of 60-40, now you're back to that original 50-50. So this is what I mean by rebalancing. Okay, so at this stage, I also want to show everyone a hypothetical portfolio and what are some of the consideration and thoughts that go through this particular investor when he constructs his portfolio. So in this particular example, I am assuming that this investor is a moderately aggressive investor. Now, if you can recall just now, earlier in my slides, for moderately aggressive investors, they have about 70% allocation to stocks and 30% to bonds. Okay, so you can see for this particular investor, he has about 30% to bonds. And I have also thrown in another assumption. I've assumed that this investor is somebody who likes a passive income, and he is also a big fan of Singapore REITs. So, which is why I've also included REITs into this particular allocation. So I have given REITs a 30% allocation, and the rest of the 40% allocation, I've just assigned it to stocks. So like I said, no hard and fast rule. Okay, ultimately, is what you are invested in and what you are comfortable with. And once you have that plan, you just need to make sure that you stick to it. Okay, so now this is the very first step, asset allocation. So asset allocation, I decide what I want to invest in and what are the percentages. Now the next step is actually product selection. So right now, I need to choose the suitable products for each of these individual asset classes that I have chosen. So I need to choose a product for bonds, for stocks, and for REITs as well. So let me start off with bonds. Okay, in the Singapore ETF space, there are actually quite limited options for bond ETFs. So I don't really have a lot of options to choose, which is why I am using this Nikko AM Singapore dollar investment grade corporate bond ETF as my product of choice to construct my portfolio. Simply because this is the first ETF, the first and I think currently the only ETF in Singapore that allows investors, that gives investors easy access to the Sing dollar investment grade corporate bond space. Now the issue with the issue with bond investing in Singapore is that corporate bonds, they typically trade in quite large blocks of at least $200,000. Now this is for rich investors, of course, this is a small change to them, but for the average retail investor out there, $200,000 is not something that we can fork out. And even if we can, it's probably 100% of our portfolio. So that's not something that we want to do. So it's usually not accessible to the retail investors. So for this group of investors, what are their options? They can go for retail bonds, which requires about $1,000 lump sum investment, but there are very limited options for retail investors when it comes to retail bonds. Okay, but if you want to invest in wholesale bonds as a retail investor, there is a way, and the way for you to do that is through an ETF, through this particular ETF that I'm highlighting on this particular slide. Because with just $50 a month, with as little as $50 a month, you can actually gain access to Singapore's investment grade corporate bond space, which was previously inaccessible to most retail investors. Now, when I say investment grade issuers, I am essentially referring to bonds that are issued by blue chip companies and companies that are quite well known. And investment grade issuers, they also tend to have a low probability of default. Low probability doesn't mean no defaults, okay? But the fact is that usually these companies are quite solid, which means that the probability of these companies defaulting on their loans is quite low. And this is in contrast to the non-investment grade bonds that you are seeing in the retail bond market, the retail bond space right now. I think most of these are actually high yield property developers. So high yield bonds, or what we call the non-investment grade bonds, sometimes it's also referred to as junk bonds. So these bonds, they are actually issued by companies that have a much weaker financial condition or a balance sheet compared to your blue chip companies. So the probability of default by these companies is actually quite high. If you look at investment grade issuers, okay, what is inside this ETF is actually bonds that are issued by the likes of Temasek, HDB, LTA, and also the three local Singapore banks. So these are very well-known entities, and these are also companies, bonds that are unlikely to default on their bonds at any one point in time. Okay, so at this particular slide, okay, but I just wanted to illustrate on illustrate the diversification benefits that this ETF has. Because this ETF is actually invested in many different sectors. And if you look at this table over here, okay, they are actually diversified across a lot of different companies. And even if in the unlikely possibility that one company defaults on its bonds, okay, there is actually minimal impact to the overall performance of the ETF because, as you can see, the highest weightage for the bonds is actually just 3.63% for the DBS Bank. So it's very diversified investment grade issuers, unlikely to default. So this is something that you can consider for your portfolio. And also, what kind of yield can you expect from this particular ETF? Okay, as of end of Feb, based on the ETF's fact sheet, okay, the average yield of its portfolio is actually about 2.45%. It is not the highest if you compare this to, let's say, your high yield bonds or maybe the dividend yields that Singapore stocks are offering. Okay, but I would say it's quite decent, especially if you compare it with the potential yields that you can get from, let's say, your Singapore savings bonds, your Singapore government bonds, or even your fixed deposits. So 2.45 is quite low, but that is also because it is investment grade. And compared to some of the other risk-free options that you have in the market right now, I think it is quite decent. Okay, so I want to state also the diversification benefits of having bonds inside your portfolio. Now, over in this chart, it shows you the performance of this bond ETF relative to the Straits Times Index. And you can see that the line in blue, which illustrates the performance of the Straits Times Index, over the past few years, the stock market has been really volatile. It can go up and it can go down very substantially. But on the other hand, you have got, if you have invested in this particular Singapore dollar bond fund, then you can see that the performance of this particular bond ETF is very steady across time. Okay, of course, the potential returns that you get from this particular bond fund is not fantastic compared to the potential returns that you can get from the stock market. But this chart basically just illustrates that bonds, they can be the potential anchor of your portfolio. So when markets are selling off, like you can see on this particular slide, especially this year, when the STI has fallen by close to about 30% from its peak this year, this bond fund has only fallen by quite a small bit, okay, perhaps less than 10 or maybe even less than 5%. So it has been very resilient, and it is able to help cushion some of the losses that you're experiencing from the stocks portion of your portfolio. Okay, so now we have selected a product for bonds. Now the next one to select is actually for the stocks portion of this moderately aggressive investor. So I think for stocks, especially if you're looking at the Singapore stock market, then I think the ETF to go for is the SPDR, Straits Times Index ETF, the one that I have highlighted just now. So it replicates the performance of the Straits Times Index, which is the benchmark index for the Singapore stock market. Now, I think this ETF is suitable for investors who want to invest in the Singapore market using a low cost and also a diversified way to get exposure to our domestic stock market. And you can also see from this particular slide over here that a lot of these companies, they are blue chip names. So when you invest in the SPDR Straits Times Index ETF, you're actually invested in companies like DBS, OCBC, and UOB. And if you look down the line, these are all actually blue chip names that make up the bulk of Singapore's stock market. And also in terms of dividend yields, okay, so this chart that you see over here is the forward dividend yield, which is the estimated dividend yield for each of the individual markets that are listed here. Okay, and you can see also for Singapore stock market, okay, its current forward dividend yield is about 5.43%. And if you compare this to some of the dividend yields offered by other markets, other global equity markets out there, and you also realize Singapore actually has quite a very high dividend yield relative to all these regional equity markets. Okay, but of course, there is this possibility of dividends being reduced this year, especially if COVID-19 drags on longer than expected. Okay, so maybe you can expect maybe 20-30% reduction in your expected dividend yields. But even if that reduction, your yield is still at quite a decent level of about 4%. And if you are expecting things to normalize next year in 2021, then actually 5.43 is something that you can realistically expect for 2021. And also, if you look at the valuations of Straits Times Index, okay, I think right now, Straits Times Index is currently trading at about 10 to 11 times its forward earnings. And at this current level, if you compare it to its historical range of its PE ratio, you can actually see that the STI is actually trading at closer to the lower bound of its historical PE ratios. Okay, but of course, if you look at 2008, 2009, during the global financial crisis, when PE ratio was actually at about 8 times earnings, so some investors might think, well, okay, maybe now it's at 11 times, it can go down to 8 times. And when that happens, you are looking at a potential downside of about another 20 to 30%. So the possibility is there, okay? But also there is the possibility that it won't go down that far. And if things start to, if we see signs of a recovery later this year or maybe in 2021, then I think right now valuations are considered quite reasonable for investors to start considering putting money into the Singapore stock market. And again, like I said, don't do a lump sum. If you're not sure, just do an RSP. Okay, so for the Singapore stock market, I've selected the SPDR Straits Times Index ETF. And before I go on to the REIT segment, I just want to mention also that for Straits Times Index, not only do we have the SPDR Straits Times Index ETF, there is also the Nikko AM Singapore, the Straits Times Index ETF as well. So these two products, they are quite comparable. Okay, but I think the SPDR Straits Times Index ETF has a longer track record. And also in terms of the tracking difference, it is slightly better than Nikko Asset Management. But if you ask me, I think these two products are honestly quite comparable. Okay, but I've just selected the SPDR Straits Times Index ETF for my hypothetical portfolio today. Okay, now for REITs, I think for REITs, I have to apologize once again for these percentages not showing up. For this particular slide, I actually want to show the breakdown of the geographical breakdown of this particular ETF into all the various geographical markets. This ETF that I've selected is actually a Straits Nikko AM Straits Trading Asia ex Japan REIT ETF. So this is an ETF that invests in Asia ex Japan REITs. But even though it's Asia ex Japan, you realize from its fact sheet that it is actually invested mainly in Singapore REITs. If you are looking at the percentage of Singapore REITs allocation, it's actually about 75% of the portfolio, which is actually this red color pie over here. Okay, and the fund also has about 20% exposure to Hong Kong REITs, which is this particular slice over here. So all in all, you get exposure to Asia REITs, the major regions, and most of it is actually invested in Singapore REITs. And based on the underlying index that this particular ETF is tracking, the estimated yield right now, based on consensus estimates, is actually about 6.2%. Now, why do we want to consider Asia REITs? Now, I think we can consider Asia REITs because first and foremost, it is very diversified. Not only do you want to invest in Singapore REITs, if you look at some of the other Asia REIT market, their dividend yields are actually pretty decent. And in this particular example, I've actually listed out the potential dividend yields of all the different REIT markets out there. Okay, but of course, I think right now Singapore REITs, they're offering quite significantly high forward dividend yield at this moment because REITs, they have actually taken a beating this year because of COVID-19. So their share prices have actually dropped very substantially. And at this kind of yield level, actually investors can start to pick up some REITs. I think for investors last year, I think a lot of them are complaining that REITs are a bit too expensive for them to get in. I think at the end of last year, the kind of yield that Singapore REIT space is offering to investors is actually about around the range of about 5 to 5.5%. But even then, there were still investors who were willing to invest. But right now, with share prices having come down substantially and with yields of about 10.3%, I think now is perhaps the time for investors to start looking at this sector again. Like I said just now, dividends could potentially get cut this year, especially for sectors that are seeing a lot of stress, like especially in hospitality and retail sectors. So distributions could be reduced, but with a 10.3% dividend yield, even if I reduce my dividends by 50%, I can still get quite a decent 5% distribution yield. And in 2021, if things start to normalize again, then of course, I think 10.3% distribution yield based on the current price right now, I think it is something very realistic to expect next year. Okay, so some of the top holdings inside the ETF, I think most of them you should be able to know. These are top names in the S-REIT space. The only exception here is Link REIT, which has about a 9.2% allocation. So I just wanted to go through very briefly what Link REIT is invested in. So Link REIT is actually a Hong Kong REIT, and it invests in and manages retail and commercial properties in Hong Kong. And its portfolio is actually very defensive because it has a portfolio of largely community retail malls. Now, when I say community retail malls, I am not talking about Orchard Ion or Plaza Singapura. If you go to the malls that are managed by Link REIT, you can't actually find your Uniqlo or H&M. But what you can find in these REITs, in these shopping centers, are your supermarkets, your grocery retailers, clinics. I think there are also childcare centers inside the shopping malls, and there are also F&B establishments inside as well. So it is a very stable REIT, and because it is located mainly in the heartlands of Hong Kong, within walking distance for many Hong Kong residents, I think that has also helped its defensiveness over the past few years. And you can see also from its dividend payouts. Okay, this is a chart showing the distribution per share of Link REIT. You can see that over the years, okay, if you want to, if you're looking out for a REIT that is paying out steady dividends, I think Link REIT actually fits the bill. And you can see also in 2008 and 2009, during the global financial crisis, its distribution per share has actually inched up slightly. And over the years, its distributions have never decreased before. And if you look at the consensus estimates right now, in 2020 and 2021, Link REIT is expected to continue its dividend growth over the next few years. Okay, so on this particular slide, I just wanted to show again the hypothetical portfolio, but it's not showing up, so I'll just keep right next to this particular slide over here. Okay, so once you have determined what products you want to invest in, the next step is, of course, to put it into action. So based on that initial percentage of 30, 30, 40, okay, and assuming this particular investor is willing and able to set aside $500 every month, then he or she should be putting 150 into the corporate bond ETF, 150 into the REIT ETF, and also $200 into the SPDR Straits Times Index ETF. And also for transaction costs, like I said just now, it's 0.08%, minimum $1 for every RSP that you have. So in this case, you have 3 RSPs inside your portfolio. So you are paying $3 transaction fee for this particular portfolio every month with every $500 invested. So that's about 0.6% of your total investment amount. Okay, and if you're looking at a monthly contribution of about $1,000, then you should be putting about 300 into the bond ETF, 300 into the REIT ETF, and 400 into the STI ETF. And again, your transaction cost is $1 for each of the RSPs, and your total cost for this ETF is still $3. So as a percentage of your total investment amount, your transaction cost represents about 0.3% of your investment amount. Now, if you want to max out, if you want to take the full advantage of the 0.08% fees, then you will have to invest a minimum of about 4.2K. So which means you have to invest in all these amounts stated in this table over here. It is only then when you can really enjoy the lowest cost in terms of a percentage of your investment amount. Okay, but of course, for most of us, I don't think we can set aside 4.2K every month to do your RSP. So maybe something along the lines of $500 to $100 is something worth considering. In fact, you just need $50 for each of these individual RSPs. So actually, minimum of 150. You can already start investing. But of course, if you're doing 50, 50, 50, then your percentages will be the same for all of them. So I think for investors, if you want to implement this 30-30-40 weightage, then I think maybe you can look at a monthly contribution of about $500. Okay, so with that, I'd just like to very quickly just share some of the takeaways. I think RSPs, it may appeal to a select group of investors, especially if you are not into the stock markets, you don't know what's happening, you don't know how to invest. I think RSPs, and specifically ETF RSPs, is a very good starting point because it is diversified. Not only is it diversified, it is also a very disciplined and fast-free way for us to stay invested in the markets, irrespective of market conditions. And I've also shared with everyone a systematic way of constructing your portfolios using RSPs. So we start off with asset allocation, which is deciding what asset classes you want to invest in and in what proportions, followed by product selection, what ETFs you want to invest in, and last but not least, you just need to review your portfolios on a regular basis and do a rebalancing if there is a need to. Okay. Before I end today, just want to sell a bit of snake oil. I think for ETF RSPs, we have recently just launched this service on the FSM1 platform. So besides just SGX listed ETFs, you can actually choose from 40 ETFs across US, Singapore, as well as the Hong Kong stock market to do your regular savings plan. Okay, we have about 40 ETFs, of course, with more down the road. Okay, and commission fees, like I said just now, is as low as 0.08%, minimum $1 a month. Okay, and I think there are a lot of merits if you're doing your investments with FSM1, because not only do we have one of the most competitive fees in the market right now, I think we have a lot of research content that is on our FSM1 website. I think for our existing clients, I think you would have read some of our research content. I hope they have been useful to you. And for prospective, for new clients who are joining us, joining our webinar for the first time, I think if you go to the FSM1 website, you don't need to have an account with us. You can have a look at some of the research content that we have on our website. And we also have this thing called an ETF focus list, whereby we curate some of the best ETFs across all the various exchanges and across various geographical regions as well. So have a look, and I think FSM1 is actually a very good platform for everyone to start your investment journey. I hope everyone stays safe from this COVID-19, and thank you so much for your time.